Hello and welcome to a special show on a new GDP series which has been released, and the numbers on your screen, the GDP numbers have come in at 7.6%. And to make a sense of what does these numbers mean, we have an eminent panel. We have been joined by Aditi Nayar as well as Kanika Pasricha. First I want to come to you, Aditi. How does 7.6% look to you?
Thank you. We had forecast Q3 GDP growth on the old base at 7.2% and for the full year at 7.4%. So I'm not sure if this 7.6% is the full year number or the Q3 number, but either way it's a little higher than what we were expecting. So that's good news. Now, of course, we need to see the back series to really get context and understand how the numbers are, both in absolute numbers as well as in terms of the growth rates.
Let me clarify to the viewers, 7.6% is the FY26 number which government is seeing that FY26 GDP growth is likely to be at 7.6%. Q3 even in Q3 it has come in at 7.6%. I beg your pardon. The GDP FY26 growth is pegged at 7.6%, and that is the number which is flashing on your screen. We'll come back with more details on what are the constituents of it. But the FY26 GDP number being at 7.6%, how does that look to you, Kanika? And if you talk about Q3 data, as we speak, it has come in at 7.8%. So Q3 numbers are 7.8% and the whole year expectation is 7.6%. Kanika, your thoughts?
So first of all, thanks Ankur for having me on the show. Completely agree with what Aditi also said. See, frankly, while Aditi was on the lower side at 7.2, we were at 8% plus handle for the quarter. We were more optimistic because of GST rate cuts leading to underlying lead indicators uptake. See, the number at 7.8 somewhere is showing the impact of the methodology change when you shift from old to new base. As per old base, we have given a number of 8%, but it seems that the methodology changes specifically with respect to double deflation method, apart from, of course, the expanded coverage in terms of data sources, GST, Vahan data for registration, for across subcomponents may have played a role. But maybe double deflation, specifically for manufacturing subsegments, may have contributed as well. So, of course, all eyes on details. Just one check. This is the real number. Nominal number matters a lot more as well when we look at this new series, frankly, because for the full year, as per the old base, it was, as per the first advanced estimate, it was coming in at 8%. But how the trend for nominal growth changes in the new base series, in my view, will be also very key to watch out for. Thanks.
Right, and if you talk about nominal GDP, as I can see the release, nominal GDP growth is pegged at 8.6% in FY26, and I want quickly your comment. Let's welcome Samir Narang to the show. Samir, what is your view on nominal GDP pegged at 8.6% in FY26?
Well, it's considerably higher than the previous estimate. We had revised it higher to 8.4%. So it's slightly tad bit better than what we were thinking. On the real GDP, we were at 7.6 for the year, so that's pretty much similar. So it is very clear that the uptick that we are seeing in WPI as well as CPI has a role to play in terms of upgrading the nominal GDP growth higher. That's a fairly positive development because the biggest worry for a number of variables which are calibrated on nominal GDP was that a slowdown in nominal GDP will have an impact on those numbers. So as it is picking up and we expect it to pick up further in FY27, that's a positive development in our opinion.
Right, and let's also look at the more constituents which have been released till now. Q3 FY26 real GDP growth has come in at 7.8%, but if you talk about the nominal Q3 GDP, it is at 8.9% as far as the latest data is concerned. Manufacturing emerges as the key growth driver post rebashing. In fact, manufacturing post double-digit growth in FY24 and FY26 as well, and secondary and tertiary sectors have grown at 9% in FY26. Let's also look at more constituents which are available. Trade, hotels, transport and communication sector has grown at 10.1% in FY26, and PFCE, GFCF both grew over 7% in FY26, indicating the demand resilience. And these are the numbers which are coming in from the release, which is coming from the government. So overall, if you talk about the manufacturing, the data has been, of course, revised. What is your sense on the numbers, on the first impression which has come in, Aditi, now that we have more constituents?
So I have just very briefly looked at the document. The sense I have is that the real GDP growth has been revised downward for FY24 and upward for FY25, on which now we have a slightly higher FY26 GDP growth number. So we'll have to look at the nominal GDP trend in detail as well in absolute terms, not just in terms of a pace of growth, because that will also be important for other fiscal aggregates like the debt to GDP and the fiscal deficit to GDP number. So I think, we really do need to look at the details, not only for this year, but for the last 2 years as well, to really get a sense of how things are. Again, if I'm not mistaken, I think the Q1 GDP growth number for FY26 has been revised downward. So, we need to really sort of look at all of this and try and make better sense of it.
And if you talk about Q3 constituents, the manufacturing growth has come in at over 13%. The mining growth is at 4.7%. All these numbers flashing on your screen. But if you talk about Q3 numbers particularly, the nominal GDP has come in at 8.9%. Samir, how do you read that number?
That's a very significant positive. And I think when you look at a number of nominal variables that we were tracking, such as credit growth, which has seen a sharp improvement to around 14% in December quarter versus a low of 9% during the month of May. Along with that, even the corporate revenues have actually seen a reasonable traction, particularly in the manufacturing side in the December quarter. Along with the stable profitability and margin. So it was expected that Q3 nominal GDP and real GDP is likely to be fairly, robust. But I would say on the nominal front, the numbers are slightly ahead of what we were thinking. And for the year as well, as has been correctly pointed out, that these numbers are slightly better. And going forward, both WPI and CPI are looking upwards. So to that extent, nominal growth is likely to be in double digits in FY27.
All right. So that expectation is coming in from Samir. How do you read, Kanika, the numbers which has been released so far? 7.6% overall figure, that is the expectation. But more importantly, how do you read the nominal GDP numbers, which has been point of debate in the past?
So very healthy numbers, Ankur, as even Samir and Aditi have pointed out. See, as per the old base and the first advance estimate, the nominal growth was pegged at 8%. Even in this quarter, we were expecting a slowdown in nominal growth versus the second quarter, which is around 8.7, 8. We were expecting a number of around 8.5, purely because inflation bottomed out in this quarter. It was lower in Q3 versus Q2 as a GST rate cut impact started to show effect. Now, of course, the numbers, specifically annual numbers on the headline, as you're stating, is 8.6 versus 8% on the old base for the full year. That's one. Second, as Samir said, I completely agree that as we move along now, starting from the last quarter, Jan to March, and in the upcoming quarters, as inflation numbers themselves normalize, they show an uptrend. That is likely to show up further in terms of the gap between nominal and real growth. See, actually, even in Q2, if you see, as per the old base, the gap or the deflator between nominal and real was around 50 basis points. But this time it's coming at around 100 basis points, if I'm not wrong, because it's stating that I think nominal is around 8.6 and real is around 7.6. So it's 100 or more than 100 basis points, which is somewhere stating for even Q3, the gap between real and nominal has gone up purely because of methodology changes in the new GDP. Of course, a deep dive needs to be seen that which sectors played a crucial role there. Thanks.
Exactly. So that is something which needs to be watched out for. But for now, the estimate is out in the new methodology, and you can see the headline figure is expected at 7.6%. If you talk about Q3, the manufacturing growth is expected over, now the manufacturing growth is actually coming at over 13%, and the nominal GDP is also showing some kind of, I would say, the positive scenario, the kind of debate we have had in the past, 8.6%, and even for the Q3, the nominal number has been quite encouraging. Now, if you talk about the revision overall, what has caught you to the surprise part? Aditi, I want to come to you if you would have seen the numbers.
So what I've understood is that the nominal absolute GDP level is 3 to 4% lower for the last 3 years than it was in the old series. So this I am a little, honestly, I'm a little surprised. I would have thought with the new sources of information, especially deeper sources of information about the non-listed space, that it would reveal a larger size of the economy. But maybe the proxies that we were using in the old series to capture those parts of the economy where information is not very frequent were actually overstating the size of those sectors. This is my very preliminary understanding. Of course, we need to go through the details. We'll be poring over the details today and over the weekend to really get a sense. But prima facie, I'm a little surprised that the nominal GDP has been revised lower.
All right, so that is a sense which is coming from Aditi. Samir, overall, any surprises for you?
Well, on the contrary, even last time, when the nominal numbers were released, it was a tad bit lower, so 1.7 or 2% lower. So this time around also, a similar trend has played out. I think Aditi mentioned it correctly. It's difference in the approach. When you do the base year revision, the earlier year growth is projected on the basis of the benchmark indicator, and you have very little information on the informal surveys or sector. So when you do the surveys and you figure out actually the sector perhaps has not grown as much as we were thinking. So that probably explains, the deviation, and it was very similar last time around as well. And we felt that it would be pretty much similar this time also in terms of nominal GDP being similar to last time. But I think what is more important, Ankur, is what is going to happen in the future, particularly with the double deflator playing out for manufacturing. We've had a very good quarter this time around, and from volume, numbers are doing fairly well as of now. So hopefully that part of the economy should do fairly well in the near term, and we should expect robust growth numbers perhaps in the 7 to 7.5% handle continuing for some more time.
All right, so that's the view of Samir. Aditi, I want to understand from you, overall, the expectation was that once these numbers are there, there will be an impact of upward revision per se. But don't you think so that it has come other way around?
That's what I was saying. So Samir and I differ on this. He thought there would be a downward revision. He was prepared for that. Roughly 2%, which is the case in the previous base revision. The actual revision which has come in is more like 3 to 4% downward, and I was on the other side from Samir. I thought we'll get an upward revision, and we got a larger downward revision than what Samir was expecting. So in terms of the fiscal ratios, they're all actually slightly worse. It's only on the margin. But again, our expectation going into today was that they would end up being slightly better.
All right, with the amount of data so far, Kanika, how do you read Reserve Bank of India will read these numbers in the next monetary policy?
I would say it's a close wait and watch. See the numbers, where is RBI for FY26 in terms of real growth? They're at 7.3, 7.4. Now this number gets revised to 7.6. Completely agree with what Samir also said. What is the outlook or the way forward matters more. And in the coming quarters, we see growth normalization. So we are at 7% for the next financial year, which is FY27. I'll just pinpoint one point which is very important from RBI's perspective. So we hold the view of prolonged pause on rates. We do not see the base revision either in CPI or GDP affecting our monetary policy view as of now. But if you see FY24, the real growth has been revised down from 9.2 to 7.2. For FY25, it's been up from 6.5 to 7.1. And FY26, it's from 7.4 to 7.6. Somewhere it's actually showing an uptick in potential GDP growth. Of course, it's a growth normalization. So the outward swings of 9% have been lowered to 7, but some sort of a growth average moving towards close to 7% for the potential growth also that was mentioned in the economic survey. So they believe that it's more from 6.5 to 7. Somewhere that GDP growth numbers are trying to signal that. Of course, we have just got data for 2-3 years. A long-term trend needs to be mapped out as well. But broadly, it's looking like GDP settling closer towards 7%, even as per the new base. That's a good feeling. It's a good number to work with. Overall numbers, I would say very buoyant. Looks like manufacturing is one of the key drivers of this significant gap between nominal and real growth. But of course, we need to do that deep dive. Thanks.
Of course, that deep dive is needed, and it's puzzling because on one year the revision is lower and the other year the revision is higher. So how should one map how the trajectory is going to be? And that is something which question will be there even for Reserve Bank of India for the forecast they are making, which is said they will come out in the next monetary policy. Samir, and therefore I want to understand from you, which are these variable factors?
No, so I think Kanika also spoke about it in terms of the overall projections that the RBI had given were largely for H1, Q1 and Q2. And it seems that, there is an upward bias to some of these numbers in terms of the high frequency indicators that we are seeing, aside from the methodological changes, because that tells you what is the momentum in the economy. Credit growth is fairly good and buoyant. Vehicle sales even reported in the retail level from E-Wahan, which is also a component for GDP now, have been fairly good in the month of February as well. And exports, which were a key headwind, have also been taken care of because US tariffs have actually been reduced now closer to 10% from 18% that we were thinking earlier. So that all should add to, the growth momentum as we go forward. We were closer to that 6.87% range, but if tariffs are lower, high frequency indicators show robust momentum in the domestic economy, then obviously one would see that the GDP growth from RBI standpoint also settles slightly ahead of 7%, which is a fairly good place to be in. And at the same time, the second part of the equation is inflation, where we believe should be closer to 3.9% next year. So in a situation where growth is around 7%, inflation is around the target, RBI can just wait on a long pause and let the transmission mechanism continue and play a game of low for longer, so that the benefit of lower interest rates are visible for the larger economy for a longer period of time.
All right, and even the economic survey had mentioned the potential of India being 7%. But let's also once again take a look at the constituents which has emerged so far in the Q3 FY26 GDP. The primary sector growth at 1.7%, agriculture, forestry and fishing growth at 1.4%. Similarly, mining has come in at 4.7%. Secondary sector has grown at 10.1%. Manufacturing has grown 13.3% as we highlighted earlier. And electricity, gas and utilities has grown just 1.5% in Q3 FY26. Similarly, if you talk about construction, that has come in at 6.6%. The overall tertiary sector grew 9.5%, trade, hotels, transport and communication grew at 11%, and financial, real estate, IT and professional services grew at in double digit actually 11.2%, and public administration, defense and other services also grew at 4.5%. So this is the latest data which has come in out for Q3 FY26. Aditi, I want to come to you on your reading of overall numbers, and what do you expect Reserve Bank of India to do?
I think the second part is easier, definitely in for a prolonged pause in line with what Samir and Kanika have both said. Reading of the numbers, I think we need a little bit more time to really get into them and understand things. So for instance, while the number for this quarter is a little higher than what we thought, and definitely we got a great manufacturing number, I think the construction number is a little lower than what we've been seeing in the last couple of quarters. The agri growth number also seems to be a little bit on the lower side. So we need to really understand how each of these sectors' trajectories are growing to get a better sense of how to do the projections going forward. Now, top line, I would say GDP growth will probably be 7% or a little higher than that in FY27 in real terms. And nominal terms, definitely we're looking at 10 to 10.5% now. So that's all good news in terms of slightly higher growth numbers going ahead than what we would have thought, for instance, before the budget. So after seeing the double-digit capex growth in the budget and the tariff-related, changes that have happened since then, we are looking at a growth number which is going to be 7% or a little higher than that. But individual components, how do we project them going forward? I think that we need time to do a bit of a deep dive.
Definitely, and time is definitely needed because it's a new GDP base which has been released by the government, and as we know till now that the expectation for the economy to grow in FY26 is 7.6%, but more importantly on the back of 13.3% manufacturing growth, Q3 numbers has come in at 7.8% for FY26. But with this, it's time to say thanks to our guest. Thank you so much, Aditi, Samir, as well as Kanika for joining at this hour and explaining all these numbers, the time it was released, which we know this is very, very difficult. Thank you so much for joining.
Thanks.
Thanks.
And up next, an exclusive round.